Hello everyone, I am CA Prateek and you are watching the third part of the revision lecture for the PGBP chapter for CA Intermediate Examinations. Let us get straight into the video. Basic parts of the PGBP we had discussed in the first two parts of the revision lecture. In this video we are going to discuss about the special businesses. Firstly, let us start with speculative business. Sir, what is speculative business? Speculative business is a business where there is purchase or sale of commodities, including stocks and shares, without the delivery. So, if there is no delivery in the purchase or sale of commodities, stocks or shares, etc., then it is called speculative business. For example, intraday trading of shares. It comes under speculative business. It means a business which plays purely on price difference, that is speculation. Okay, now why is this speculation business special, sir? Because loss of the speculation business can be set off only against the profit of the speculation business, and speculation business can be carried loss can be carried forward only for a period of 4 years, which you are going to link with the set off and carry forward chapter. Now be very careful, dear students, because if you find any words such as derivatives, futures, options, currency futures, forward contract, hedging contract, etc. at recognized stock exchange, then don't confuse it to be speculative business. It is actually normal business. Okay. Now let's come to section 35 AD. Section 35 AD is a deduction which is allowed for some specified businesses. However, 35 AD benefit is not allowed for the assessees who are choosing the option of the new tax regime under section 115 BAC. So very important. Now, what are the specified businesses? What are the specified businesses? There are 14 specified businesses. Number 1, cold chain facility for agricultural produce. Number 2, warehousing for agricultural produce. Number 3, warehousing for sugar. Number 4, laying of natural gas, crude or petroleum oil pipeline network. However, this business is there, no, natural gas, crude, petroleum oil pipeline network. This is allowed only if it is an Indian company and if the company makes the pipeline available for the others, okay, to use the pipeline. Next, number 5, slurry pipeline to transport the iron ore. Number 6, a hotel which is of 2-star or above category, means 2-star, 3-star, 4-star, 5-star hotel which is in India. Next, hospital with at least 100 beds in India. Number 8, housing project for slum redevelopment. Number 9, housing project for affordable housing. Number 10, inland container depot or container freight station. Number 11, semiconductor wafer fabrication manufacturing unit. Number 12, new infrastructure facility in public-private partnership mode. And number 13, production of fertilizer. And finally, number 14, beekeeping and production of honey and beeswax. So all these 14 businesses are called specified businesses. Sir, what is the benefit given to specified business? The benefit given to specified business is that it can claim 100% of the deduction, okay, of the capital expenditure also in the year of commencement. It can also claim 100% deduction on the prior period expenses. Okay, so very big deduction is given. However, section 35 AD benefit is optional. This is an amendment which is applicable for May 21 exam onwards. Section 35 AD benefit is now an optional benefit. Okay. Next, however, 35 AD benefit, that is 100% deduction on the capital expenditure and even prior period expenditure, it is not available if the expenditure is for goodwill, financial instrument or land. So no benefit for goodwill, no benefit for financial instrument, no benefit for land. Okay. Then again, no benefit of section 35 AD deduction is given if the payment, that is the expenditure, it is made to a person in a day exceeding rupees 10,000 in any mode other than account pay check, account pay bank draft, electronic clearing system or any other prescribed mode like credit card, debit card, net banking, IMPS, UPI, Bhim Aadhaar Pay, okay, NEFT, RTGS, etc. So the payment to procure the capital assets should only be via the prescribed modes. If it is not in the prescribed mode and the payment is more than 10,000 to a person in a day, then such amount is not eligible for the deduction. Okay, then the business should be a new business. It should not be commencing by splitting up or reconstruction of an existing business. Then if 35 AD is allowed, then on the same amount the deduction like 10AA and income based deduction under chapter 6A are not going to be allowed as deduction. Okay, then in case of plant and machinery, only new plant and machinery is allowed for deduction. However, if old plant and machinery is within 20% of the total plant and machinery, then old plant and machinery will be considered as new plant and machinery. Hence, deduction is allowed for old also. And one more thing, if there is an imported plant and machinery, that is a plant and machinery which was used outside India and now it is brought into India, it is also considered as new plant and machinery if no depreciation has been claimed on such plant and machinery. Okay, so this was new plant and machinery. Next, if there is any loss, okay, after if there is any loss from the specified business, then it can be set off only against the profit of specified business, and loss of specified business can be carried forward for infinite number of years. Okay, then if an assessee claims the benefit of section 35 AD deduction for the purchase of certain asset, then that asset has to be used in the specified business for at least 8 years. Okay, if it is sold or destroyed within 8 years, then the amount received on sale or the amount received by the insurance company will be treated as income under PGBP. And one more thing, if before 8 years itself the assessee uses the 35 AD specified asset in a business other than the specified business, then the PGBP income will be deduction claimed under section 35 AD earlier minus depreciation that would have been allowed had the 35 AD deduction not claimed, okay, will be the income under PGBP. I'll repeat once again, if the assessee uses the 35 AD asset before 8 years itself in a non-specified business, then PGBP income will arise. What is the PGBP income? PGBP income is deduction which is already claimed under section 35 AD minus the depreciation that would have been allowed on such asset. Okay, and this same amount that will become the PGBP will also become the cost of the asset for the business, that is non-specified business, for claiming depreciation. Okay, I hope you get my point. Similarly, this income is not applicable for sick industrial company. So if a company is a sick industrial company, then even though it transfers its asset from a specified business to a non-specified business, no need to tax any income. Okay, so I hope you are clear with section 35 AD. Very important, sir. Do solve the questions under section 35 AD to be thorough with the provision. Now let us see. Okay, let us first see section 10AA. Section 10AA, deduction for special economic zone. The section 10AA deduction for special economic zone is also not available for section 115 BAC, that is the assessee who is choosing the new tax regime. Okay, firstly, who is eligible for SEZ deduction? Firstly, a person should be manufacturing or producing or providing services. Okay, and the assessee should be defined as an entrepreneur as per section 2J of the Special Economic Zone Act of 2005. Only then the assessee is eligible. Then there are certain conditions to claim the SEZ deduction. First condition in sir. First condition, the manufacture or production or service should begin between 1/4/2005 till 31/3/2020. Okay. However, there is an amendment which has been added which is telling that even though the service providing or production or manufacture did not begin within 31/3/2020, if the assessee has got the letter of approval required under the Special Economic Zone Act, then also the deduction is available to such assessee. Okay, next, the unit in the SEZ should be a new unit It should not be by splitting up or reconstruction of an existing business. However, if an assessee is covered under section 33B, then this condition is not applicable. Okay, not so important, ignore it. Now, in here also, the condition is that only new plant and machinery should be used. However, old plant and machinery is allowed if the old plant and machinery is within 20% of the total plant and machinery. And if a plant and machinery is imported from outside India to India, even though it is a used one, it will be considered as new if no depreciation has been claimed on such plant and machinery. Okay, so the same point we learnt in 35 AD also, we are learning in 10 AA also. And here you have to get a report of a chartered accountant certifying the correctness of the deduction under section 10 AA. Only then, after all these conditions are satisfied, 10 AA deduction can be availed by the assessee. Now let us see how to calculate the deduction. Deduction under 10 AA is equal to export turnover of the SEZ unit divided by total turnover of the SEZ unit multiplied by profit of the SEZ unit. So export turnover divided by total turnover into profit of the SEZ unit. Okay, be very careful. So in the first 5 years of the business, 100% of the above amount, that is the formula amount, will be allowed as deduction. In the next 5 years, 50% will be allowed as deduction, and in the further 5 years, 50% will be allowed as deduction, subject to the condition that the amount should be transferred to SEZ reinvestment reserve account. So what will be the deduction in the year 11 to year 15? Amount transferred to SEZ reinvestment reserve or 50%, whichever is lower. Now, export turnover means what? The consideration for export brought into India. Total turnover means what? Total turnover of the SEZ unit. From all these turnover, you should reduce if there is any freight, telecom or insurance to deliver or render the service outside India, or if there is any expense in foreign exchange to render the service outside India. Okay, export turnover, total turnover and profit should be taken only of the SEZ unit. So here you have to be very careful. Then if there is on-site development of computer software or service outside India, it will be considered as deemed export. Next, if there is any loss that is to be brought forward, then you have to reduce that loss from the eligible deduction, and only the remaining deduction can be claimed by the assessee. Fine. Now, condition for further 5 years. So if the assessee wants to claim the deduction under in year 11 to year 15, then amount has to be transferred to SEZ reinvestment reserve account. This SEZ reinvestment reserve account is nothing but a provision created in the balance sheet. So the money will be lying with the assessee only. It should not be deposited in any bank or anything. The money will be with the assessee only. However, it should be separately kept as SEZ reinvestment reserve account. And this SEZ reinvestment reserve account money should be used to buy a new plant and machinery. Okay, within 3 years from the end of the previous year in which the reserve was created. Okay, then the particulars of the above should be submitted along with the return of income. Now I told you that the SEZ reinvestment reserve money should be kept by the assessee safely. Okay, the assessee should not use this money to give dividend. The assessee should not remit this money outside India, and the assessee should not remit the money outside India for creating an asset outside India. Okay, if the amount is misutilized, means if it is used for one of the three purposes, then such amount will be deemed as PGBP in the year of misutilization. And if within 3 years the assessee is not able to purchase any plant and machinery, then after 3 years that amount will become deemed PGBP, that is profit and gains of business or profession. So there are changes in section 10 AA, that is the section relating to SEZ. In your study material it is given in the deduction chapter, but I am taking it along with PGBP chapter itself. So now itself you make the changes. So in section 10 AA, sir, what change is there? There are 3 minor changes. What are the changes? Number 1, The Section 10AA deduction can be claimed only if the income tax return is filed within the due date. Okay, so within the due date to file return of income, the assessee should file the return. If not, then 10AA deduction will not be allowed. Then next update, it is that we have seen this export turnover, correct? Export turnover. Sir, what is this export turnover? Export turnover will only be considered as the convertible foreign exchange brought into India within 6 months from the end of the previous year or within further period as permitted by RBI. So what is considered as export turnover? Export turnover will only be the consideration which is in convertible foreign exchange. So it should be in foreign exchange, and that foreign exchange also should be brought within India within 6 months. Within 6 months from the end of the year, and if RBI gives further permission or further extension, then within that extended period it should be brought into India. Next, consideration is deemed to be received in India where export turnover is credited in a separate bank account maintained for that purpose outside India with the approval of RBI. So what they are telling now, listen here. Let's say a person is doing export to USA. From India to USA, let us take example of Mr. A, correct? So in USA, let's say the turnover made from India to USA is $1 crore US dollar. Now what does the RBI tell? What does the act tell? The act tells that this 1 crore US dollar should come within 6 months from end of year. It should come to India, but sometimes it is not feasible to bring that money back to India. Maybe it might be required to be there in the US also for further expenditure. So what this person Mr. A will do, Mr. A will take permission from RBI and he will tell that I will maintain separate bank account in USA. Okay, please grant me permission that whatever money I put it in the separate bank account in USA, it should be considered as money received in India. If RBI gives the permission, then such money also will be treated as it is received in India or it is brought back to India. Okay, other points not so important. So this was deduction under special economic zone. So since there is an amendment, you read this section carefully, there is a chance that it can come in examination. So now let us come to the next topic, that is agricultural income. So I told you that the constitution has not given the right to the parliament to tax agricultural income. The power is with state legislature. So Income Tax Act provides exemption on agricultural income via section 10 clause 1. 10 clause 1 provides exemption on agricultural income, but for that you should know what is agricultural income. Okay, first, agricultural income is defined under section 2 clause 1a. What is agricultural income? Number 1, rent or revenue received from a agricultural land. Okay, but the land should be in India and it should be used for agriculture purpose. If the land is outside India, then that income is not eligible for the exemption under section 10 clause 1. Okay, so be very careful. So if a land is in USA and if I am getting agricultural income from USA agricultural land, the income is not exempt. It is very much taxable in India. Okay, now ownership is not necessary to get the rent. Okay, I told you example of subtenancy. So if I am getting the land on rent and I am giving the same land on rent to another person, then the rent that I am receiving, okay, it is also agricultural income if the land is a agricultural land. Next, number 2, any income received from the agricultural land by the activity of agriculture is called agriculture income. Example, plowing, sowing the seeds, etc. And also one special point, that income from nursery, it is also agricultural income. Then if there is any process which is done to make the produce fit for the market, it is also agricultural income. I told you example of the process of removing the chaff from the paddy crops to get the rice. So this process, The income earned by doing the process is agricultural income. And finally, sale of agriculture produce. If raw crops are sold, example tomato. So if tomato is sold, then the money received from the sale of tomato is agricultural income. However, if the crops are sold after processing, you have to see whether the process was compulsory for sale or process was not compulsory for sale. If the process was compulsory for sale, for example rice cannot be sold in a raw form as paddy. Rice has to be processed. Okay, the paddy crops are processed and rice is sold. Okay, so hence when rice is sold, the process is compulsory for sale, hence it is agricultural income. However, if process is not compulsory for sale, example tomato ketchup. Tomato can be sold directly also. However, if tomato is converted into ketchup and sold in the market, then it contains business income also, it contains agricultural income also. Sir, how are we going to differentiate both? Answer is using rule number 7. Rule number 7. In rule number 7, agricultural income, how to find agricultural income? Agricultural income is fair market value of the agricultural produce minus cost of agricultural produce. You will get the agriculture income. Then how to find the business income? Business income is equal to sale of the final product minus fair market value of agricultural produce that we had taken earlier minus any further cost that is done for agriculture. So I gave you example of tomato. If the example, the fair market value of tomato is 10 rupees, cost of tomato is 4 rupees, then agricultural income is 6 rupees. Then if selling price of tomato ketchup is 50, okay, in that you have to reduce the fair market value of tomato, that is 10, and further cost to make the tomato ketchup, that is 30 rupees. Hence 10 rupees will be business income. That is how we divided 16 rupees total income into business income of 10 and agricultural income of 6. Okay, I hope you are clear with the example. Now let's come to composite income, that is section 7a, section 7b and rule 7a, rule 7b and rule 8 of the income tax rules. Rule 7a talks about rubber, latex, crepice, senex, etc. In such case, A is to B, that is agriculture is to business, will be 65 is to 35. 65% agriculture income, 35% business income. In case of rule 7b, which talks about coffee, there are two categories. If coffee is grown and cured, then the ratio is 75-25. 75 agriculture, 25 business. If the coffee is grown, cured, roasted and grounded, then agriculture 60, business 40. So the ratio is 60-40. Sir, what will happen if the coffee is only roasted and grounded? If it is only roasted and grounded, then it is purely business income. Okay. Then rule 8 talks about tea. For tea, the ratio is 60-40. 60% agriculture income, 40% business income. Then I told you one special point. In case of these composite incomes, that is 7a, 7b and 8, the full depreciation has to be reduced from the cost of the asset, okay, to find the WDV. Next. So first, what is the agricultural income? Rent from the agricultural land. Second, income from the agricultural land. Okay, and third point is income from farmhouse. Sir, what is a farmhouse? Farmhouse is a building which is on the agricultural land or in the immediate vicinity of the agricultural land. Means it is just touching the boundary. Okay. Income from farmhouse will be considered as agricultural income only if the farmhouse is used as a dwelling, that is a residence for farmers, or it is used for storage of the agricultural produce. Else it will not be allowed as agricultural income. So now in all these points related to agricultural income, we spoke about agricultural land. Let us discuss what is agricultural land. Very simple, sir. Any land on which the agriculture is done is called agricultural land. Okay. This agricultural land can be a rural agricultural land or urban agricultural land. Now, what is a rural agricultural land? Agricultural land in a rural area is called rural agricultural land. Okay, then what is urban agricultural land? Any agricultural land which is in the urban area, and it should be assessed to land revenue, and it should be assessed to land revenue only if both the conditions are satisfied. It will be called agricultural land. So rural area na enna, if a land is in rural area, it will be considered rural agricultural land. But if the agricultural land is in urban area, it will be called as an agricultural land only if it is assessed to the land revenue. Okay, chitta, dangal, patta, etc, etc. Now, what is urban area? What is urban area? Urban area is an area with the population of 10,000 people or more as per the last census. 10,000 people or more. Then one more point. Okay, I gave you the example of Coimbatore. So if the population of Coimbatore is 10,000 or more, Coimbatore will be called urban area. If the population of Coimbatore is more than 10,000 up to 1 lakh people, the 2-kilometer area outside Coimbatore will also be called as urban area. If the population of Coimbatore is more than 1 lakh up to 10 lakh people, then the 6-kilometer area outside Coimbatore will also be called urban area. If the population of Coimbatore is more than 10 lakhs, then the 8 kilometers area outside the boundary of Coimbatore will also be called urban area. Okay, so I hope you are clear by seeing this circle and diagram. Fine. Next, I gave you some examples of agriculture and non-agriculture income. Sir, rent received from land for grazing cattle is agriculture. Sale of seeds, agriculture. Sale from flowers, creepers like money plant, etc., agriculture. Sale of bamboo, agriculture. However, income from milk of cattle or milk products, not agriculture. Livestock, not agriculture. Poultry, dairy farming, fishery also not agriculture. Basically, any income which is got from animals and not crops, it will not be called agricultural income. Then, for selling the agricultural produce, if I give any commission, that is also not agriculture income. Then, if I sell forest products like timber, etc., that is also not agricultural income. And if an agricultural company pays dividend to its shareholder, then the dividend received will not be called agriculture income. Okay. So those are the examples. Then in agricultural income, we studied the concept of partial integration. Partial integration. I told you in class that the government is not happy by giving so many benefits to the people. Okay, the government is telling you are getting the benefit of basic exemption limit also, you are getting the benefit of slab rate also, and you are getting the benefit of agriculture income exemption also. So they cannot tolerate this. Hence what they are doing, they are telling that whatever agriculture income is earned, that much they will block it in the slab. That much slab rate benefit will not be given to the assessee. Okay, I gave you detailed example in class. Let us see what are the conditions when this partial integration concept will apply. Partial integration concept will apply only if all the three conditions are satisfied. Condition number 1, the agricultural income should be greater than 5,000 rupees. Number 2, non-agricultural income should be greater than the basic exemption limit. And number 3, the assessee should be enjoying the benefit of basic exemption limit. So who are such assessees? Individual, HUF, AOP, BOI and AJP, that is artificial juridical person. So if all the three conditions are satisfied, you have to do partial integration. How to do partial integration? Step number 1. Compute the tax of agriculture income plus non-agricultural income. Step number 2. Compute the tax of agricultural income plus basic exemption limit. Okay. Step number 3. The total tax is equal to step 1 minus step 2. And then step number 4. You should add the surcharge, education cess, or reduce the 87A rebate if any. Okay. So like this you should do partial integration. So with this, agricultural income comes to an end. Now let us discuss the final concept, that is the concept of alternate minimum tax, AMT. Alternate minimum tax. I told you, right? The government is not happy when the assessees claim so many benefits. So, an assessee who is claiming either the benefit of section 35 AD or section 10 AA or income based deductions under 80 IA to 80 RRB, then for such assessees alternate minimum tax is applicable. Okay, let us see what is alternate minimum tax. Firstly, it is non-obstante clause means this section will override all the other provisions of the income tax law. Next, it is applicable to all the assessees except company. Sir, why not company? Because for the companies, MAT is applicable. MAT we will study in CA final. Okay. Now, for the assessees for whom the AMT is applicable, have to pay the AMT on adjusted total income, that is ATI, or the regular income tax, whichever is higher. So alternate minimum tax or regular income tax, whichever is higher, should be paid as AMT. Okay. What is the rate of AMT? It is 18.5% of the adjusted total income, and in case of IFSC, that is International Financial Service Center, it is 9% of adjusted total income. After finding this 18.5% or 9%, above that you should add 4% education cess surcharge, etc. Okay. Now, how to calculate adjusted total income? Adjusted total income is basically the total income on which you should reverse all the deductions under section 35AD, 10AA and income based deductions. You have to reverse them. So how to reverse them, sir? First take the total income, okay, then add back the deductions which have been claimed under section 10AA, then income based deduction under chapter 6A, that is 80 IA to 80 RRB, and then deduction under section 35 AD. So add them back. However, if 35 AD deduction will not be claimed, then the assessee can claim depreciation, correct? So the depreciation which would have been claimed should be reduced from this answer. So the final amount that is received will be adjusted total income. So what you should do? Total income, add back the deduction claimed under section 10AA, okay, chapter 6A deductions, that is income based deductions, and then 35 AD deduction, and then reduce the depreciation on the 35 AD assets that would have been available. Okay, you will get the adjusted total income. On this ATI you should calculate 18.5%. Now I will talk about AMT credit. Sir, I told you that actual income tax or alternate minimum tax, whichever is higher, should be paid by the assessee. So the assessee goes to the government and is telling the government that this is pure injustice. You are doing wrong. First, because of the deduction, my tax has become so low, and now you are not giving me the benefit of the lower tax. You are asking me to pay the alternate minimum tax. So the government is telling, chill bro, I will give you this alternate minimum tax as credit. Hence, whenever alternate minimum tax is greater than the regular income tax, then the difference will be available as AMT credit. This AMT credit can be carried forward for a period of 15 years. And when can you set off this AMT credit? It can be set off when regular income tax is greater than AMT, but it is restricted to the excess of regular income tax over AMT. So I gave you an example where the AMT is, let's say the AMT is how much? 18 lakhs, okay, and the regular income tax is how much? Only 4 lakhs. Then how much will be the AMT credit? The AMT credit will be 14 lakhs. Correct? That is the excess of AMT over regular income tax. How much should be actually paid to the government in the year? AMT should be paid to the government during the year. This 14 lakhs can be carried forward for 15 years. Correct? Finally, let's say after 3 or 4 years, let's say the actual income tax is 10 lakhs and the AMT is only 7 lakhs. Actual income tax 10 lakhs, AMT is only 7 lakhs. Then how much is the difference? Difference is 3 lakhs. So they are telling this 3 lakhs difference can be set off using this 14 lakhs credit. So this 14 lakhs will become 11 lakhs and this 3 lakhs can be set off. The balance, that is 7 lakhs, need to be paid to the government. And if there is a year in which AMT is not applicable, so let's say income tax is 10 lakhs and AMT itself is not applicable, hence it's 0, then this credit of 11 lakhs can be used to set off this entire income tax of 10 lakhs and nothing needs to be paid by the assessee. Okay, so read the provisions carefully. Sir, will the government give any interest over AMT? Answer is not at all. No interest on AMT credit. Okay. Any other provision like advance tax, interest under section 234 A, B, C, etc. should be calculated on AMT. If AMT is applicable, then advance tax and interest should be calculated on the AMT credit, not on the actual income tax. So be very careful. And in your examination, it is not necessary that the examiner will tell you directly to calculate the AMT. You should see whether AMT is applicable or not in the question and you have to find the answer. Okay, so question can be hidden one also. Next, who is exempt from AMT? Who need not pay alternate minimum tax? Firstly, we discussed companies are exempt from AMT because for them MAT is applicable. Next, any assessee who does not claim any deduction under 10AA 35 AD or income based deduction, for them also AMT is not applicable. Okay, then any individual, HUF, AOP, BOI or artificial juridical person whose adjusted total income is up to 20 lakhs, for them also AMT is not applicable. So if adjusted total income is above 20 lakhs, AMT applicable, up to 20 lakhs, AMT not applicable. Then even if AMT is not applicable, AMT credit is available, it can be set off against the regular income tax, which I already told you. Then if AMT is applicable, assessee should get a report from a chartered accountant certifying the computation of AMT and adjusted total income. What is the due date of this report? It is 1 month before the due date to furnish return of income as per section 44 AB. Okay, tax audit. So these were the provision of AMT credit. Okay, so in detail I have given you the revision lecture for PGBP chapter. I hope you are thorough with it. Solve as many questions as possible so that you do not make any silly mistakes. Keep preparing. Okay, take care. See you in the next video. Till then, bye bye.